Back again. Big week. Fun week. Twitter is on fire. Richard Brennan is on fire. A lot of good tweets out there. I love the Twitter, man. This Spaces needs to revolve around Twitter and all the posts. It's where our good thinking is throughout the week. A lot of great tweets. Bill Dunn. Let's talk about that. I listened to Niels and Allen. Then towards the end, I got fired up. A lot of good stuff there. We got to correct. Neil's got to correct what you said. Uh, JK, joking. Okay, I got to start off by saying I made a mistake last week. I need to apologize for. I'm not a very good host. Sometimes I'm a very undisciplined speaker, and I listen to myself and I'm like, where was I going? I didn't even finish my thoughts. I was on a podcast last Thursday and I started talking about return stacking and I got excited because I never talked about it before. And I was going on and on about how much I liked it. I love return stacking. I like it. I like it. And I'm an investor in Corey's return stacking, our SBT fund. And I think we've talked about it here, and I did it, and everyone likes it with, especially the new way he's doing the replication. We like that bottom up, top down. I don't know what that exactly means, but I don't know which one is which. I know what it means, but I really like it. And so, anyways, on that podcast on Thursday, was talking about it, but I went back and listened. I never really finished my thoughts on it, which are not that great. Mainly, though, it was just that whenever you come out with products, ETFs, for instance, everybody, including me, I did mention myself in this as well, that it's kind of like you've got to create something that you really like and you really believe in. And then it's not going to be perfect, though. You've got to sell it. And I was trying to make that point, and I botched it. And then that morning, then last Friday morning, I botched it again, even worse. And so, with how I described it and the implications I made, which don't go back and listen, but it was regrettable and undisciplined and stupid. And I already apologized to Corey because I really do like the return stacking, and so I'm apologizing to you guys and to him again. And hopefully, one of these days I'll meet him. Those guys are smart. They're like go-to guys for the quants on Twitter and elsewhere, and people really like them, and I like them, and I think they're really good and smart, and they love trend following as much as I do. So I think that comes across too. Jerry has to make this point that no one likes trend following as much as he does. That's just, I don't know why I give that impression. I mean, I know why. I'm just undisciplined and I get too excited and I don't follow through. So, anyways, let's move on from that. Oh, you ready? Oh, no, he's not ready. Um, Oleg.
Hi to everyone. I was connected just now. So, of course, I'm very happy to be here, as always. Hi, Jerry. Hi, Maurice. Hi, Bruno. Hi, Richard. Hi, Alp. Hi, Jerry Smith, Bro, and Josh Cohen, and all the guys I see here. My old friends and new friends. So, only friends here. And I would say that this week was very interesting for me because I have published my notes from Jerry's conversation with Niels, and it was every conversation. It's really fantastic that, as I have said before, every conversation with Jerry is full of insights for me, and I listen this conversation almost every day for years, and I found insights. For example, about in the recent conversation with Niels, there was insight about the turning points, about the wall control. For example, Jared said that I think one of the problems with that, which about wall control, which I think Rich told us in 1983 on this particular subject, is a lot of things happened around the turning points Unfortunately, it happened 5 times before the turning point. Oh, it's great, I think. And for example, the next quote: the more you drill down into these trends as to what's going on inside of these trends, especially the large trends, the big trends at the turning points, now you're down to a sample size. It's so small that you start to see there is an issue with that. It's really a great thing to understand this all because really, well, control looks good for investors, but in fact, it's very important to understand that really a lot of things are happening around turning points. Really, a lot of things, but it can have. I have a lot of research on this topic, and I have done this research maybe 6 years ago, and really we can see different things. But the problem is that it can be 5, 6, 7, 8, or 10 times, and there will be no turning point. And in fact, you will lose your money in the long term if you are not using classical transform approach, long-term approach. This wall control is not the best, I think, systematic decisions. So, of course, for me personally, at least, classical transform is the best thing that was invented in our space. So let's get started. I'm very happy to be here.
G'day, Oleg. G'day, Jerry.
Hey, Richard, how are you?
Yeah, very good. And listen, if you've got concerns about occasional slip-ups, given the amount of content that you produce on all of this social media, which is huge, if you're concerned about a couple of little events, I wouldn't even lose sleep about it. I mean, yeah, look, I don't know how many times I've sort of got into that situation where I said, oh, why did I do that? I remember getting into the sharp wars with Rob Carver and thinking, why did I go into that can of worms? And, it's something that sort of preys on you when you're sort of sleeping. Why did I do this? Why did I do that? But in the scheme of things, it's inconsequential. And you realise at the end of it that it was nothing. But anyway, Jerry, why don't you start with your concerns with the podcast with Niels and Alan? What was it that raised the hairs on the back of your neck?
Well, I did want to say, I love Niels, and I think that he lets me critique his program because it's got a lot of content, and it's the go-to place for CTAs and trend following. And I feel like, though, I don't know if I've said this, but, jokingly, and that's part of the problem. That's part of the reason I get into problems is because I try to be funny, so excited that I'm going to make somebody laugh. And you can't even hear people. You all are muted. So it's kind of like a bummer. But so anyways, I think that I should be on all of the podcasts and just sitting in the background. And as they say these things, I can correct them, right? I need to correct. That's right. I can correct Niels and his guest, and not Richard, of course, but real time. Because now, like, it's been a week almost, and it's not the same thing. So I need to be the podcast ombudsman, real time, making sure it gets out there correctly, like it ought to be.
I think I've listened to you so much, Jerry, that I think I'm totally aligned with you. So when I was listening to that podcast, I think the hairs in my neck were rising at exactly the same time as yours were. That was in relation to diversification, the statement on that.
Right. Well, one of the things that's interesting about the podcast, and I know you're still hung in there. I had to drop out. And one of the things that, I don't know, it kind of, I'm sure you feel the same way, but I think that there's a fine line here of like, I can't really describe it. You're debating these issues and you know what the other person is going to say, and yet you still want to debate them, and you don't really make much progress because it's definitely possible that there's nothing new to say. You've been on the podcast, not just Top Traders, but any podcast or any discussion, any argument, like I do the argument with Mike Melisinos. And so we don't agree on everything. So if you're doing these things regularly, you're going to go over some ground. And anytime they talk about 300 markets or volatility management, correlation management, DPS, dynamic position sizing, they start chuckling because here we go again, right? And so you expect some of that. But then there comes a time where sometimes I feel like um, there's no reason to discuss these things. We already proved that we were correct. So they act like we've never talked about this. Well, wonder what the answer to this question could possibly be. How about reverting back to what Jerry and Richard said a few weeks ago? And so,
Exactly.
yeah, and so you're still there, and you have to put up with this. And so I used to go outside and walk my dogs and say, I am totally worn out. I'm listening to this again in an episode I'm not there, and it's just like whatever we said, it never happened. So, anyways, with that being said, oh yeah, Alan starts out. It sounds like this debate is gonna rumble on. Of course, it's gonna rumble on because you don't acknowledge that we've already said something. Oh yeah, and it's this classic error that 5 to 10% of the trades are going to be outliers. At one point, I remember someone on the podcast saying years ago, 5 to 10, right? 5 to 10 trades are the outliers. And so as soon as possible, I was saying, no, it's not 5 to 10. It's 5 to 10%. So if you trade 300 markets, 30 markets. If you trade 21 markets, 50 markets, 60 markets, it's the same 5 to 10%, right? And so maybe there's some benefit, certainly, to smoothing out the outliers around the track record. They don't get bunched up as much, maybe. Or I think Richard maybe have some other reasons. He thinks it's just not a straight line, 5 or 10%. However, I just think this has been talked about, many, many times, and they were sort of getting to this idea that if you trade all these markets, you can't meaningfully was one of the key words, allocate to OJ. If OJ is 1 out of 50, then you have a more meaningful allocation. And then if OJ is 1 out of 300, the allocation is less meaningful. But any sort of limitation on 300 is covered by this 5 to 10%. Classic. If you're DPS, dynamic position sizing, you may not get those same outliers in the same level. Although Neil says, sometimes you'll get more because you happen to dynamic position size at the right time. I agree. But overall, when you look at all the data and you do the back test, obviously you're going to get out of some of those big outliers before the long-term trending stop gets hit. Long-term trending stop's going to have a bigger drawdown. You're going to have a smoother return, blah, blah, blah. So I do think that they have something going on there. It's not meaningful. It is meaningless. You can't put on a meaningful position in OJ. That's exactly right. You cannot, because I trade 300 markets. However, it doesn't matter because I trade 300 markets. That's one of my 5 to 10%. And I am going to get that OJ not as big as somebody who trades more meaningful position, a position that's going to be 1 out of 30, 60, 100. But I'm getting more of those, and there's more diversification in those outliers. And so it's just, I guess we'll keep going over that over and over again, but it's 5 to 10%, guys. And you're right, it is meaningless, but it's irrelevant that it's meaningless. In some ways, I remember Rich saying back in 1983, sort of one of your goals is to convince yourself and to have practically a situation where all the trades are kind of meaningless. And for me, I'm in nirvana on that, because what can one trade do to me with a full loss? And my trading stops my stop losses are pretty big. They're pretty loose, And so if I take a full loss on a full position, all 4 systems, I lose 12 basis points. So put that in your spreadsheet, and you should better figure out pretty much how I do things. 300 markets, 12 basis points. And so I really don't have any anxiety of putting on a trade. It's really nice, right? And but even if you are trading 20 markets or 50 markets, you've got that stop loss, and it's going to be a small part of your capital when you take a loss. It may not be 12 basis points, but still it should be inconsequential as it relates to agonizing over, should I do this next trade? Oh yeah, you should do it, because the downside is like close to zero. So I think you're in a really good situation where you can make everything kind of meaningless in that regard. And what's meaningful is adding all those trades together. What do you think, Rich?
I think you're right, Jerry. And this is how people connect the dots. Okay, so we say 5 to 10% of the trades in our outcomes are outliers. Now, here's where non-linearity kicks in. What we're saying is that 5 to 10% of our trades are, let's say, on average, 30 ATR or 30R. The 90% of trades are, say, 2R. So it's a sum of conditional probabilities, Jerry. It's if you trade 300 markets with only 5 to 10% of trades, you get many more outliers. In the impacts of outliers dominate your distribution. If you trade 100 markets, it's far less, even though they're both 5 to 10%. It's because it's 5 to 10% times 30 ATR, and as opposed to 90% times 2 ATR. It's a sum of conditional probabilities. And this is where I released an article today. It's a fantastic article from a gentleman called Bruce Arthur, who is a professor at the Santa Fe Institute, deep in complexity science. And he talks about the law of increasing returns. This is something we've got to jump on as trend followers because this substantiates our argument, as opposed to the law of diminishing returns. So when people talk about diversification, they're typically thinking in the case of the law of diminishing returns, where after, say, 50 or 60 uncorrelated markets, the marginal improvements of diversification decrease. Now, under the law of diminishing returns, which is a law you find in equilibrium-based systems, that is a justified statement. We, however, are saying we are not dealing in equilibrium-based systems. We are dealing in non-equilibrium-based systems. We are dealing in the tail regions of the distribution of market returns. And in that environment, we actually get a different law called the law of increasing returns. This is where positive feedback kicks in, amplification properties kick in. We suddenly can't start applying simple statistics to assess our performance. We've got to apply non-linear statistics or non-linear methods to substantiate our performance. So we've just got to hold to our argument that 5 to 10% of our trades are outliers, which in general principle they are. I think we could probably lift it with better diversification methods, with system diversification, maybe up to 13% or 14, but it's about that. But then it's 14 or 10% of trades that are 30 ATR. So they dominate our performance. It gives us our step-ups, our non-linear ascending equity curves, which is better than the sharp line, the straight line of Sharpe. Sharpe is a consequence of Markowitz, is a consequence of efficient market hypothesis, is a consequence of neoclassical economics, econometrics. These are all bound in these really traditional assumptions of economics, which is wide of the mark. It's assuming that economics follows principles in equilibrium-based systems. We recognise that markets are far more complicated than that. They're complex adaptive systems. And in our system, in the real life, non-linearity is the thing that drives our returns. In that instance, therefore, we are very justified in talking about 5 to 10% of our trades being outliers, because we are capturing that non-linearity of those outliers in respect to the balance of the trades in our distribution.
I like this because we are divergent traders, and of course non-linearity is one of the main things that we must understand, that our trading strategies work in this way. And convergent, yes, linear systems, they look smooth for investors. Investors like this, but it's like a landscape in the beach of a sand, as I have said before. So a big event or something like that, and it will be a very big bad effect on the account if you're system is linear, I think. So nonlinearity is a big strength because it's, I think that nonlinearity, it's adaptiveness. It's a part of our adaptive process. It gives a lot of strength for a system.
Hey, Moritz, you're a survivor of TTU. What's
Yes.
going on? How do you think? What are you thinking?
This is very nicely said. I am a survivor.
It's not nice at all. I apologize, Niels.
I'm doing great. Lovely day here today. Looking forward to the weekend. Relatively good trading week. Smiles on my face, so all good. And yesterday, adding to your conversation about the markets, I had this really interesting dialogue with this London-based CTA that I had never heard of called Baumor, and they were recently interviewed on Michael Covell's podcast. I really like that podcast. I recommend you guys listen to it. I think it came out earlier this week. It's pretty fresh. Um, they are, I think they're classic trend following people like us. They fully systematic, trend only. You know, all of the stuff that I is music to my ears. They trade 16 systems, four kind of like categories. One of them is moving averages. Another one is breakouts, and the two other ones I don't know. They didn't disclose that. And each of these four they trade across four different time frames and speeds. So they have this diversification, and that's all fine. But they're really adamant, and this I just can't get my head around this. They're really insisting that trading 21 markets only is superior to a more diversified portfolio. And this guy Gareth, he's a math guy, like real, probably I don't know, but like comes across as a really really good mathematician. And
But he's not a physics guy, Moritz.
it's not. But so he's really like Moritz. If you're trading more than these 21 markets, you have all the diversification you need with these 21 markets in, three equity indices, three bonds, three currencies, a few commodities. That's what they do. He says, like, I'm catching everything that matters. Everything that matters on the macro space, I catch. And when these trends happen, I have a really meaningful impact on my portfolio. They risk 120 basis points per trade, and then they only trade these 21 markets. When you look at their returns, their Sharpe ratio is 0.9. They have a fantastic year, 2023. Not like Mulvaney, but not far off. They're probably in second place. And the prior years have been very, very good return years as well. They do have some position sizing that goes on after the trade to control their risk. So yeah, that is the dynamic position sizing that we don't like. So they do that. But I just this argument of, hey, you have to trade 21 markets if you're trading. Let me paraphrase. What they said is, if you're trading more than 21 markets, then you're spreading yourself too thinly, and you're leaving money on the table. You're engaging in riskier markets that have more slippage, and you're not getting enough bang for the buck. It's kind of like what they said. Like, I just can't reconcile this. Like, for me, this doesn't compute. Like, simple example, if you're trading, they only trade the long bond, the treasury bond, the 30-year US bond. That's the thing that they trade for the US bonds. I go like, okay, yeah, I trade that bond, but I also trade the 10-year and the 5-year and the 2-year and SOFR. Jerry told us that there's now a 3-year. Okay, let's trade the 3-year, whatever, right? We know that they are correlated. So rather than trading one, I'm trading 5. And I would split my risk budget into 5, say, equal parts. It doesn't necessarily have to be equal, but let's say it's equal. And I must have a diversification benefit that way, because they're very highly correlated, but they're not perfectly correlated. Like, if these things get going, then I should be long or short all of these bonds, and I should have probably the same trade outcome as you guys. But occasionally, they aren't going to be exactly in the same direction. Like, the 30-year bond might be doing something slightly different than the 2-year bond, and I will maybe be out of one and still short the other, or the other way around, or have no position at all. And over many, many samples, that diversification benefit must materialize. I mean, it just must. If it doesn't, tell me. But this is why I'm trading all these markets. So yeah. I just this was the thing this week that got my head spinning, is this London-based CTA that is refusing, really refusing, and they think they have mathematical arguments and that supports them, refusing to trade more than 21 markets. 21, that's it. And everybody that trades more than 21 is leaving money on the table and spreading themselves too thinly. Period. There you go.
Well, I listened to this podcast because I saw that you had listened to it, and so I listened to it, and I tweeted about it, and I want to get into it after we exhaust Alan and Niels. But I will say that towards the end, there was some weird stuff that they started mentioning, and I didn't tweet this part, but it was something about cycles, or yeah, it was some weird stuff that was trend
Dow
following plus.
theory. Dow theory, I
Yes,
think.
yes. Yeah, that I thought I heard, but with the English accents and the transcript is pretty cheap off of YouTube. I thought I heard that, but there was other things too that they said, not just Dow, but that was definitely one word they use. And now you're saying dynamic position sizing. Okay, look, it's right back to what we were saying a few minutes ago. They're denying the 5 or 10% outliers. They are not hunting outliers. I forgot the word they used, but I'll find it in a few minutes when we get to that tweet. It's not broad trends, but there's something like that's what they're after. These big secular broad trend moves, like the bonds last year, and that's not what we're after. As I've said before, I appreciate that. I appreciate that because I don't know, technically speaking, in my world, if there were any outliers in that bond trend. We made all that money in the bonds because we were short the whole sector and the whole sector went down. And with the um, managed future CTAs that vol manage and the dynamic position size, they're trying to get rid of those crazy outliers. So let's just say, for our sake of argument, that the short-term interest rates were the ones that had the outlier because the ATRs were so small, and so they made a lot more than the 30-year bond. Well, if it gets too out of control halfway down on that trend, we're going to start scaling that sucker back because the vol is too high. And so they're going to turn that into a market that's behaving like the rest of the markets. And so this is where all of managed futures is really doing it. Not only they're not trading OJ, if they were trading OJ, they would be scaling it back to where it wouldn't be the type of outlier that I would get. So once again, it's these broad trends. And if you're doing that, you can do it with 14 markets. And so 14, 21, it doesn't matter because the bottom line is you're not hunting outliers. And at the end, they did sort of say, I didn't tweet this either because I was just didn't want to say too much, but they do sort of say, well, it doesn't have to be these 21. And if clients came to us and said, hey, make it more, make it less, do another 21, or we don't like these 21 that you've chosen, they're like, oh yeah, we would do that as well, or whatever. I don't see much of a mystery in this, and I'm not that impressed because they're basically trading fewer markets than most managed future CTAs who dynamic position size. But so what? It reminds me a little bit of the old turtle way, where you could have this one trade that would have a really big bang for your buck. But I really do think it's just the way you described it, Moritz, which is when we go into some of these sector moves, and I trade maybe 30 or 40 different interest rates, and you trade them all evenly, and I'm short all of them last year as they're continuing to go down. To some degree, they start behaving like hundreds of different systems because when they rallied in March, I got nicked and got out of a couple. I actually went long one partially, and then it all reversed around. And so it's kind of like you don't know where the markets begin, and it starts behaving like different systems. They're slicing and dicing up this interest rate move into four systems and 20, 30, 40 markets, and it's just this beautiful thing that you're really not missing anything at all. It's enhancing. Um, if you could do the exact same thing if you were split up the four sectors into 10 or 20 or 30 or 40 each and traded them that way, and you'd get the same outlier, the same sort of performance that they got. It would just be a smoother ride.
I did research on this topic, and I have found that every new market you trade, even very 100% correlated market like gold and platinum, for example, or Brent or crude, even if it's, and we have talked about this topic before, it gives you a diversification benefit. Really, it gives you a diversification. And I'm not talking only about outliers. Of course, we know some great stories when Jerry have told us when in 1993, as I remember, silver had a big outliers and gold set there. Yes, of course, but it's not. It's maybe I think it's not very often situation. But even if we can see on a daily basis, silver and gold are going in the same direction, but um, our initial stop may be hit by, for example, in gold and not hit in silver, and so we catch this outlier in silver. And if we have a lot of market, if we have, of course, if we have a lot of enough money for this diversification, it's a very huge benefit to have such type of diversification. Of course, even in the correlated markets. Of course, if we have not much money in our then we in our account, then I think it's better to trade the market that looks more uncorrelated. But it's not maybe the perfect decision. But it's better decision in this situation where your account is not very big. I think only this, but of course, diversification benefits. Great thing.
Hi guys. Hey Jerry. Hi everyone else. This trading 21 markets. So I think that you can live with it in trading. The commodities, the credit, the forex, in some shape or form. You may want to push the boundaries a little bit. Your returns are not going to be so smooth as a result, and you won't be using small position size and putting your trading at risk. And also you have to use a correlation matrix because of that as well, because each position is so large that you have to calculate something else there. You cannot afford to trade the Brent and the crude at the same time. But you can actually live with it. The problem arises if you want to trade single name stocks. So that's a different ball game. So these guys, I'm sure they're not trading single name stocks because, with 20, you cannot have exposure for US single name stocks, let alone for the global single name stocks. So it's, when these managed future guys or the relative momentum traders, when these traders do talk about their business, their art, their craft, they usually talk about it from a very from a one way. And I figured you have to be trading some large number of stocks, definitely more than 20. I don't think anything else less than 30 or 40 would cut it, because in S&P there are 11 sectors, so you would want to be diversified under those 11 sectors in some shape or form, and there are subsectors within sectors. So really 21 is just not going to do it. But those guys are not trading single name stocks, so And this year, of course, S&P has done very well. Nasdaq has done very well in 2023. So if you are an index only guy, yeah, you're going to get the advantage of it. But I wouldn't change 1 year's performance, the ability to trade those single name stocks. I mean, at the moment, the volatility is high, so a lot of managed futures funds will not be, or anyone else who's doing dynamic position size at the moment is staying away from the US stock market, because the VIX volatility index has seen higher levels that indicate that those guys are either going to cut their positions short, winning positions because of this high volatility, or they are not going to take any new positions. Okay. And I've coded this for myself as well. Yeah, I mean, there are years that I get the benefit out of it, like 2011, for instance, or 2018. If I incorporate a mechanism where I'm filtering out trades specifically when the VIX gets higher, yeah, my returns are get smoother, but I'm losing a lot of, I'm giving away a lot of returns when COVID comes along and when there is a very sharp move, because what happens is, I save, some negative returns on 2011, 2018, but I'm missing out a lot of the 2020 coming back, from March to June, and my entry gets quite a bit of delayed. So the real question is, would you like to put a market filter to be able to smooth out your returns, and lose some of the momentum in the COVID years? And the answer that I have given for my trading is no. I rather have some, choppy trading in 2011, 2018, but get the full benefits of the COVID years. So, every trader needs to, give a decision about their trading. So there are some hard choices to be made. You cannot get the best of the both worlds. But so yeah, no, I say no to the volatility management in any shape or form, including the, this 21 markets is a joke when it comes to single name stocks. That's my point of view. Thank you.
You have to do what you have to do, and if you can only trade 21 markets or whatever, but it's sort of like the debating, the argument of it. Like if I traded 21 markets in my account because I had a small account, I would know better that I wouldn't want to do that. And then I would. So I think that's the issue. What you have to do, but you don't. And it'll be fine. I think you can make good money. I mean, I used to trade 20 some markets, but when I first started, so you can do it, but I wouldn't intellectually argue that that's optimal. Okay, I want to move on before we finish. We haven't finished with. I wanted to one more tweet I did with Niels. Most trend followers believe that all markets have the same ability to trend and they should deliver the same expected return over time. I gave that an A plus on a tweet. Yes, that is true. That's good. That's very good. I wish I said that. Well, I wish I'd have said it less than 1,000 times. The main benefit of trading more markets is smoother returns. A plus again. I like that. That is true. I think it's true. I mean, I think that is the big benefit. I love that idea, smoother returns. Now, he goes on to say but this is this is where I'm inconsistent, I guess, and I contradict myself. Those who trade more markets, me, don't care much about Sharp though, whereas the benefit of trading all the markets is smoother returns. So you're trading all these markets, but you don't care about Sharp. But that's the big benefit of trading all those markets is smoothness. Aha, not so fast. No, is they mixed up the topics there. They got confused. We don't care about Sharp because we're hunting outliers and letting profits run to the degree that the back test says is optimal is cutting profits short and limiting that if you pay attention to Sharp. So Sharp is going to penalize letting profits run, hunting outliers with one entry, one exit, and a stop loss. So the same person, for an example, me, does trade the 300 markets because maybe it gives me some extra smoothness, robustness, smoothness. No extra parameters, no extra bells and whistles on my systems, no extra rules. And you could criticize, well, it's not that much more. Go on, criticize all you want. Yeah, exactly. I'm going to agree with you. Whatever limitation you find with trading 300 markets, I'm sure I would agree and get the back test right, and I got the same results. However, it's all I'm willing to do in order to attempt to smooth things out. But my dislike of Sharp is not a contradiction because my dislike of Sharp is not centered around the markets that I trade. It's centered around the fact that it Sharp penalizing letting profits run because
I reckon we keep
volatility.
away from the term smoothness, Jerry. Smoothness caught us in the trap. I think what we do is, I think we try to minimize adverse volatility and benefit from beneficial volatility. That doesn't, I don't think that smooths us. What that does is it gives us asymmetry. And I think that's a critical thing. If we slip into the trap of accepting their argument that more diversification gives smoothness, it's sort of, they will take that as us assuming that we are looking towards Sharp. I think that Sharp is the worst measure in the world for the classic trend follower that hunts outliers because it penalizes beneficial volatility. So I think our argument is better framed by saying, hey, we use diversification to get correlation benefits to reduce our adverse volatility. We accept that. In fact, you guys use diversification to reduce your beneficial volatility, but you're doing that to get a straight line. We're doing that simply to restrict our adverse volatility and ensure that our adversity is linear in nature. But we are capitalizing on beneficial volatility with these step-ups, these non-linear outliers that push that equity curve higher asymmetrically.
Very good. Oh, yeah. Okay. So now let's move on to the London CTA, the Trades 21 markets. Oh, they came up with a new term, and I love it. And this was worth listening to just because they coined this new term. I'm so sad I didn't come up with it, but I'm all for using it, and I might adopt it because it's pretty cool. Now, I do think, as Moritz was kind of alluding to, they have some weird stuff going on that's not classic trend following. They want us to ignore that. They probably do some DPS. We kind of want to ignore that. And so I do think that this is something I've noticed that like some of the top traders unplugged, SocGen 20, one of them in particular was like, he wanted to say his big thing was, I want to be the best trend follower ever in the world. And I just want to concentrate on trend following. So they want to have their little bells and whistles that really, don't wait for the trend to reverse the single exit, and they want to still call themselves trend followers and classic trend followers. Okay, so we got to just live with that. We can't, who am I to stop that? And it is 99% of managed futures does do this to DPS. Okay, I can't stop them, and I'm not going to argue that they want to be called what they want to be called. Okay, however, he goes on to say, with that said, he goes on to say, I've never followed that commercial direction. I'm not sure what that means. I forgot. Here it goes. I've always tried to keep trading as retro classic as it should be, especially around the strategy side, the markets, the signals, the entry, stop, exit. Classic trend following will always work. The simpler, the better. And so this retro classic, it's even better than classic trend following. It's retro classic. I love that. Michael Harris, my friend, goes, trend following will always work, quote unquote, if you can take the pain for many years. This is the big if. And I think that's pretty true. So I think retro classic could be something we adopt. What do you think? Hello, Absolute. Are you ready to chime in?
Yeah. Hi, guys. Hi, everybody. Yeah, very interesting conversations. I have to admit that I haven't listened to much podcasts last week, and I can't wait to hear them all. So I'm assuming there was a new one with Nils, and also I'm gonna looking forward to listening to Covell's with that London CTA. So my opinions on this subject, I think we're discussing a couple of or three different subjects, but I think they're very interrelated. One thought that comes to me as we're talking diversification and number of markets is that even with classical trend following, with no DPS, with no position sizing, my guess and my well, not guess, this can be tested. I haven't recently tested it, but from the test I've been running a while ago, maybe 10, 15 years ago, is that, and you guys can correct me if I'm wrong, is the more markets you add, so whether you do position sizing or not, so whether you do classical trend following or do position sizing, the more markets you add, the more your performance will seem to look alike. And also, the more
Alike what? What does that mean?
they will look
What does alike mean?
alike, they will look similar. Like, let's say you trade 300 markets with classical position sizing and you trade 300 markets with position sizing, the performance will differ. Whereas if you trade 20 markets with classical trend following and the same 20 markets with position sizing, the performance will diverge depending on how many outliers you catch in the 20 markets that in the 20 market universe. However, if the market universe is 300, I think the performance will be more similar than if the universe was 20 markets. And also, what the performance of the big market universe of both systems, which will also be similar, the performance of both systems will look similar, more similar to the performance of the position-sized 20 market universe. So let me explain. This may be complicated. So there's four scenarios. We have four scenarios here. One scenario is with 20 market universe, another scenario is with 300 market universe. And in both market universes, we have classical trend following and position sizing. Same market universe, same everything. So there's four instances. Classical 20, DPS 20, classical 300, DPS 300. So I'm making two statements. One statement is that the difference between classical and DPS in the 20 market universe will be bigger than the difference in performance between classical and DPS with 300 markets. That's one statement that I'm making. And another statement I'm making is that the performance of both markets, of the performance of classical 300 and DPS 300 will be similar, will be closer to the DPS 20 than to classical 20. So basically what I'm saying is if you want to approach the performance of 300 markets, if you want to approach the performance of 300 markets, you're much better doing dynamic position sizing on 20 markets versus classical trend following 20 markets. You'll have a bigger range of outcomes depending on which 20 markets they are. So if you want to approximate trading 300 markets with both DPS and classical, so if you want to approach classical 300 and DPS 300, your best bet is to do DPS 20 rather than classical 20. So this is my.
I love that, and I
I think that's spot on. That is spot on. I think
makes perfect sense.
So yes,
Perfect sense. It would just be a lot less work. Yeah, a lot less work.
and there will be
but
a
I wouldn't
much
do it.
bigger divergence of performance. Well, yeah, and it will be a much bigger divergence of performance where Mulvaney's in the World Cup, and there's a reason why he's trading 40 markets, because depending on which 40 markets he's trading, he may or may not shoot it out of the ballpark or just have a flat year or down year when the DPS and classical 300 are having a good year, depending on which 40 markets he's trading. So there will be a bigger divergence in performance. Doesn't mean that he's doing something magical when he's shooting it out of the ballpark, or when he's underperforming when when he diverges in the negative side. So and then I had another thought on diversification. Okay, and so this is connected with my first claim that classical 300 will be very similar to DPS 300, and this is again where this comes from. So in order for classical to show huge divergence from DPS, it has to have a big outlier with significant size where you put a bet with significant portion of your portfolio. So example, where does that matter? If you trade 20 markets and one of them is OJ and OJ has an outlier, right? You're going to have that big outlier that's going to differentiate your performance from a DPS who trades OJ and maybe cut size and whatever. But if you're trading 300 markets, the 1/300th of size that you put in OJ will be insignificant in terms of your commodity's performance. So OJ may have an outlier, another commodity may not have, but if you're trading 300 out of which, let's say 1/4 is commodity. So now we're talking hypothetical here. So if OJ is now one of 50 commodities markets instead of one of 4, your bet to that, even with the non-linearities in everything, it's still not going to move the needle on your overall performance. And to the extent that commodities move a needle in your classical portfolio of 300, there have to be substantial moves in the commodity sector for it to move the needle. Just OJ is not going to do it. The fact that the DPS guy cut size a little bit or you didn't cut size, and by the way, the DPS 300 guy is also going to catch the OJ, but with slightly less profits than you. So that's why the performance is not going to diverge a lot. For you to have a meaningful performance, for something to move the needle, it has to be a big chunk of your portfolio. And in order for something to be a big chunk of the portfolio, it has to be a big chunk of an asset class. So it has to be a big chunk of commodities or commodities as a whole, or interest rates, big chunk of interest rates.
I don't agree because you're not paying attention to our idea that 10% of the trades will be these outliers, number one, and then you're saying that. Well, I just talked about this.
No, Jerry, I listen.
Hold on. So that's what you're ignoring. Number one, the fundamental principle that it doesn't matter how many markets you trade, you're going to get about 10% outliers. And then you're sort of pigeonholing and describing how these trends are going to work, and which is these secular moves in commodities or interest rates or currencies or stocks. And you're saying that because that's what happens with your portfolio or dynamic position sizing portfolios, that's what's going to happen with people who lets profits run. And we've said over and over, I mean, you can just disagree, but don't state it as fact when you know we're going to come back once again. This is like a replay of Top Traders Unplugged, where we say these things, and then what we say is not acknowledged, and you go off as if I've never spoken before. And the fact of the matter is, we appreciate, I'm just going to restate what I said before, we appreciate these secular moves. And I made money in that big bond move. I don't even know if there was a legitimate outlier in it. And I hunting outliers, and at the same time, I'm making money when there are not outliers. But to say that commodities move and OJ is just one, well, I know commodities move and then they don't move. Nothing moves except OJ and sugar and coffee, and it's not even coffee in general. It's OJ in the commodities, in sugar and cattle, and it is London coffee that's had the big outlier right now. And so there is no big secular move in the commodities that we're picking up specifically as commodities just move generally higher. That's not happening. We are getting exactly what we're trying to describe, which is without this big commodity move up, we're getting OJ, live cattle, feeder cattle, cocoa, London coffee. And so this is the difference. I do think, though, that even though I'm trying to give the impression that we do make money when you have these big moves in the dollar, in the commodities, in the interest rates, that we're getting those plus the outliers when you don't have those big moves. That is occurring, but I wouldn't be surprised if the DPS traders are getting better movements in the bond, for instance, where there maybe wasn't that much of an outlier trade in any one particular market, because DPS probably helps them in that regard in the same way. Well, not in the same way, but as they get punished for reducing their position in OJ, God knows how many times.
So, I mean, just to make the point, if your risk budget is the same, the way I understand what Absolute is saying is, if your risk budget is the same, you're going to come to a similar point with a very diversified portfolio. Like I'm at the moment running 130 markets plus 70 shorts, so it's like if we just say 130. But if I would have run something else, half of it, he's saying that with the same risk budget, your returns would be more or less the same in a 30-year spectrum, but the variance, the dispersion of the returns are going to be different when people are running 21 markets, and I totally agree with Jerry's point that you can get away with 21 in the classic portfolio, like when you're trading equity indices. But my point, and I also have a strong view that you cannot get away with 21 markets if you're trading single name equities. It's just not going to happen. The diversification is not going to be allowed. So this 21 markets conversation is all about trading equity indices point of view, but not single name equities, which is a huge difference. But I think the way I understand Absolute is this, and he might be right on that. Trading more markets would mean smoother returns, right? And it means that there will be huge divergence for people and traders who are actually trading 20 markets. So that's all right. And the only question is whether you're making more money as a classic trader or as a dynamic position size trader when your risk budget is the same. And I think classic guys are making more money for the risk that is being taken. Thank you.
Well, I think that I can agree that I don't know if I can agree with everything Absolute said initially, but I definitely can see how, just to try to be conservative since I haven't looked into this, but I think that I could agree that 300 markets is going to look more similar to DPS than fewer markets, 20 markets would look to DPS. But whether it's similar or the same, I don't know. 300 DPS, 300 classic, that I don't know. That I don't want to say, but I will I can definitely see how it would look more similar than because with 20 markets DPS, 20 markets classic, yeah, I mean, all hell could break loose. You could get so lucky getting out quicker on the DPS or staying in longer like OJ, and just got fewer opportunities to smooth things out versus the 300. But that could probably be true about almost anything. Compare anything to 300 markets classic, it's going to look more like it than if you only traded 20 in each one of those.
Yeah, Jerry, look, my concern is this. We've chosen an example, let's say 25 markets, and then that hypothetical scenario, they've said, if there is OJ in that 25 markets versus a portfolio of 300, where there's OJ in that portfolio of 300, the impacts of the outlier in our 300 portfolio is going to be less because we've got 299 markets offsetting that outlier. Now, yeah, that sounds great. However, there's selection bias in that very statement. We've chosen a hypothetical scenario where we said, we've used OJ as the example. Now, that's a fairly exotic market to start with. And I don't think that people trading a 25 market portfolio are necessarily going to have OJ in it. That's they won't probably have timber in it. They won't have some of the things that we specialize in, these things with idiosyncratic, unique tendencies. So they'll have generic markets. They'll have markets that are basically sector-based markets that have demonstrated over the course of time that, when the tide rises, overall for a particular market sector or segment, it lifts all those markets. And they're going to choose the market that exhibits that best property, which is a form of trend. I'm not disputing it's not trend following. It's just not outlier hunting. So in our 300 portfolio, we are reducing selection bias, which is an incredibly important principle when hunting for outliers, because we simply don't know where those outliers are going to arise. And I think the examples I've seen in my track record, the outliers have been driven by idiosyncratic tendencies. They're things like London sugar versus sugar. Sugar hasn't had the outlier, London sugar has for me. It's in relation to my systems and it's relation to the particular properties of the market I'm trading. I'm highly diversified, but Bitcoin, some of these sort of unique sort of markets that might not necessarily be represented in a 25 market portfolio are going to be driving performance simply because of their idiosyncratic tendencies. The Amazons, the Teslas, they're things that are driven by the features of that particular market that is being traded. They're not necessarily sector specific. There's serial correlation in that. There's absolute momentum in that. We're not looking at cross-sectional momentum. I think a lot of trend followers actually are looking at cross-sectional momentum. So when they're trading a 25 market portfolio, they're looking at these trends that occur when the tide lifts across sectors. They're not necessarily looking at the absolute momentum that exists in the serial correlation that exists in an individual return stream. I think we've got to be very careful how we define what we do, because I'd like to say that we are not trend followers. I'd like to say that we are outlier hunters, which puts us in a class of our own. It therefore necessitates an understanding of what does it mean to be an outlier hunter, and what are some of the features that we do as outlier hunters that aren't relevant or aren't manifest by other trend followers. So I appreciate that these different sort of classes of trend follower exist, but they're not all the same. And I think we need to distinguish ourselves from them.
Yes, just to mention though, Richard, in your example between sugar versus London sugar, so if two traders are using the same risk budget, I believe you're going to get the same overall return. Let's say one portfolio is trading New York sugar and London sugar, and the other is just trading New York sugar. Of course, the one that trades New York sugar is going to have twice as much as risk. Then I can see that some of the traders would argue that, all right, we might be losing money for that specific year, but in a couple of years we're going to have a catch up because of the risk allocation. So over the long term, Niels keeps saying that there is not much difference, and I think that's an important argument. Is there a difference over the long term? If
Well, I
everything
don't
else.
think. Yeah, I don't think there is a great deal of difference over the long term. So, but can you just imagine that being your choice? Um, what's your excuse for not trading both? It doesn't matter over the long term. Seriously, seriously, that's what you're saying versus let's trade both and smooth it out a bit without any downside of more rules, more parameters. And sugar is just a perfect example of where this 21 market thing is a total fail. It's a fail because it's so easy just to go ahead and trade them all. Okay, it takes a little bit more work. They're young. What the hell are they doing only trading 21 markets? They have way too much time on their hands. They're getting into trouble. They should be trading 121 markets because you're picking up on sugar. Can you imagine running a back test and coming up with this idea of the commodities that are correlated with each other, like sugar, and saying, oh, well, sugar's kind of correlated with whatever, coffee. And you say, well, let's just choose one. And then you get screwed because London sugar. You didn't have London sugar, for God's sake. You didn't even think about that because it has the same virtual name. And
Exactly.
and run your stupid correlation. I tell you, everybody on the podcast is better at math than me, but I just don't forget how dumb correlation is when it has nothing to do with the magnitude. And can you imagine? What do you think the correlation amongst those two sugars is? It's 90 some percent. And yet one had a bigger trend and it was stronger. And then another thing that kicked in is for me is that the systems, the overlay of the trend following system, you could have probably been a lot closer to making the same amount of money in um, both sugars if you hadn't have used trend following, because the trend following overlay, my super loose pants, it even got me out of the sugar, New York sugar, and I had to abandon my initial small ATR, get back in at the highs with a new ATR, and that screwed New York sugar for another reason. So it wasn't just that London sugar had a better trend; it was that my system screwed me up. Buy and hold, it could be very, very similar return. So you have all those things going on. Oh, and I wanted to finish talking about those guys. Oh yeah, this is what they say. One good trade will impact our portfolio. I'm not going to panic and look for 300 markets to find trends and find myself in a position where we need at least a dozen trades on site all the time. I'm not sure if I got that right. The source of alpha, this is what I was trying to remember. The source of alpha is hunting. No. It's not hunting anything. The source of alpha, this is a quote from the podcast. The source of alpha is an economic cycle. We will double capital every 3 to 5 years.
Oh dear.
Yeah, I mean, come on, man. You got to. Where's compliance? Okay, so the source of alpha is this general trend. And so there you go. They're just like managed futures. We're classic. We're retro classic. Blah blah blah. No, got to throw a flag on that. If you know what that means.
Jerry, but I think that when somebody says that, it's like justifying the buy and hold altogether, because in the end, if there is a trend, you only have to withstand the big drawdowns and you'll be fine, because at the end there is a trend. And at the end it doesn't even make sense to do trend following, because that trend will eventually emerge and the world will grow. It's just an issue of, okay, hold on to that. And the problem is that you cannot hold when you are 80% down on an index, like it happened in the best track record of the world, which is the United States. But I think that when you are, I mean, I believe there are economic cycles, but I think they are impossible to predict. But if there is an economic cycle and that's your edge, then you only have to do buy and hold and be then have mental fortitude to withstand them.
Yeah, I don't know. One of the things that bothers me about, I guess you're talking about stocks, but one of the things that bothers me, and it really makes me happy about trend following, is the tenuousness of 4% of the stocks responsible for all of the profits, or the majority of the profits. And the solution is to own the index, so you have all of them in there. You don't miss them. And yet, if you traded each one of them individually, um, the 500, you could put trend following over them, and they would 90% of them would contribute profits. And you can just imagine how does that happen? Because the trend following is picking up these trends. It's not like 4% had trends. It's just that 4% that you randomly bought and randomly didn't get out of, those are the ones that happen to still be materially higher over this period of time. And there you sit, just sort of watching, versus this gentle average holding period of 1 year, overlaying it, and you participate in so many trends, probably all 500 over a long period of time. Had an outlier, had some nice trends, all 500, 4% to all 500. I don't know. I can't even explain why that makes me nervous to buy and hold. I want to move on to, there was another article I tweeted I really liked. I like this guy, Spitznagel. I don't think he likes trend following, and I try to craft some of these tweets to leave out the trend following criticisms. He only likes what he does, which is buying out of the money calls to protect stocks. Yeah, the Spitznagel guy, partners with Taleb. But I like his quotes. He has some really good quotes. When it comes to safe haven investing, the cure is often worse than the disease. If risk mitigation isn't cost effective and supportive of higher overall returns in the long term, and it's not worth it. The trader's job is not to make prescient market forecasts. It's to profit. That means taking a small loss and moving on to the next trade. It's a love to lose strategy, an unwillingness to rely on forecasts. So, yeah, that's one of the turtle questions of the 100, the famous turtle test that I got in 1983 was one of the questions, true or false, traders should love their losses. And of course, it's true. Oh, yeah, this is my new pinned tweet from the same guy. I love this tweet. It's so amazingly good. Risk-adjusted returns are the three most deceptive, disingenuous words in all of investing. It's sort of a cover or pretense. It's meant to almost distract from the only thing that ultimately matters, maximizing wealth over time. That's pretty amazing. I'm sure y'all have some comments on that. What do you think?
It's a fantastic quote, and it's having a real crack at Markowitz Efficient Frontier. It's having a real crack at Sharp. I think it's a great quote.
Do you think, guys, that it's also great even if you don't have recurring cash flows? I mean, I can understand how it's good in terms of somebody who is earning, through his productive life and has a cash flow that can, add on to its investment. But I guess you also think that it's good for somebody who has a lump sum or is old, etc., and doesn't have any, recurring income.
I think we're in the game of absolute returns, Alp, and investors that are after a cash flow should go elsewhere. So investors that want, continuous progressive returns shouldn't be looking at us. That's the wrong camp. But we're in the game of absolute returns.
I don't mean continuous return. I mean continuous income to invest, right? I'm not talking about convex strategies, or rent-seeking strategies.
I find it difficult to choose, regardless of the situation I'm in or the circumstances. I would find it difficult to choose something I knew I should not choose. people have brought this issue to me over the years. Young traders I meet over time, they would say, "Oh, I agree with what you're saying, but I need to have dynamic position sizing and relative strength and all of these things that I shouldn't be doing essentially. And when I get to a certain AUM level, I'll stop doing that." And I was just like, "Do you think you're going to get to that certain AUM level? Or do you think you're really going to be where you want to be by thinking that you can choose suboptimal and less robust ideas because you're in an environment or a circumstance?" Another thing that I'm a little confused, I don't really, yeah, I know, this is really shocking. I mean, I'm such a literal person, and people say things, and I kind of know what they're trying to say. I can guess what the definition of these words is, but I sometimes, like, I don't really 100% sure know if I know the definition, and I don't really know what they mean by what they're saying. So I one day this week I was reading some stuff or listening, and these words, absolute return, came across, and I was like, oh, I don't know if I know exactly what people mean by absolute returns. And it was kind of like I think what Rich was giving me the impression just a minute ago, which is, um, well, smoothness, sharp, blah blah blah, but we believe in absolute returns. And I was like, oh, I don't like that. I don't think that because there's no such thing in my mind as not caring about risk. And that's what I was getting this impression that, well, you've got your risk crap going on, but we're absolute returns. And I was like, no, no, no. I am risk too. My complaint is sharp is not the proper way to measure. So I am for absolute returns, but only to the degree that I protect capital. And so I'm looking at my drawdown on closed trade equity or something, my average trade versus my average loss, my win-loss ratio. And so then I apply leverage to try to achieve my moderate or more than moderate returns. But even if we're pursuing, in some ways, I think if you're letting profits run and accepting the optimal look back periods and exit strategies on these trades like OJ, then at some point in time, you're going to look very volatile and risky from the outside. But in actuality, that volatility and lack of smoothness and profit give back is given off a false impression that you don't care about risk and that you're riskier, and you're not. You're less risky. And just because people can't see, this is so ridiculous that all of these people, all of these quants, it's like we cannot accept any kind of risk measurement that I can't see from a performance table. Seriously, seriously, that's the depth of your analysis. Well, I don't know what your closed trade equity is. I don't even understand this. My clients don't like it. I'm looking at the total AUM and the volatility and the drawdown. This is risk, and it's just absurd. And so people who let profits run and who let big profits turn into small profits and follow the system perpetually going to look like they're the riskiest and only interested in these returns without regard to any risk measurements, when it's the opposite. Just because you can't see that I'm the best in the world at protecting capital.
But Jerry, you ultimately are asking, this is a matter of trust. Like if giving your money to a third party, to a guy who says the things that you say, you ultimately have to trust him that he is protecting closed capital, closed equity, like you're saying he is. And at no time he gives you reports, daily reports, okay, out of the 100 million AUM, 30 is open and 70 is closed, and we're protecting the 70. Don't worry about the 30. So tomorrow this may change. So how do you solve the trust issue? So let's say I agree with you. I agree, but you can only do that with your own money or with somebody who you can actually see the internals and see, aha, this is what's going on. But if you're on the outside and just looking at the P&L and the AUM as it's fluctuating, what tools can you use to derive the confidence to say that, okay, this AUM fluctuation and this volatility and this MAR and this return to drawdown ratio is different from the other? Like, how would you do that?
I think you could provide these these numbers. We produce those numbers daily. Number one, and then number two. I mean, I think a lot of due diligence goes into interviewing these hedge fund managers and people. They explain their strategy, and there's a lot of faith that they put in these people, and then they end up not always sticking to what they said they were going to do, and the strategy doesn't always work. But then also, I think by the mere fact that you can, well, for the ETF, for instance, or I mean, institutional clients can get it. These most everyone would be like me. If you're an institutional client, and you want to give me a lot of money to manage. You can sit at my trading desk. I'm not going to deny you inside information. But even the ETF now, you can look at the positions and see that everything lines up with the way we're talking about it. By the mere fact that you're letting profits run, okay, that's step number one. Good job. All of those profits are running, all of those trades, and you can, in horror, go back and look at the charts on some of them and see, wow, you really gave back a lot of profit. And then number two is you can kind of figure out, if you wanted to, that all the liquidations and the losing trades were gotten out of with a really small loss. So I think those are the two things that you're looking for. Is with all the large profits, did you let them run? Did you suffer a big drawdown? If you're not suffering this drawdown, it doesn't look like you're doing what you're saying. And then are you taking those small losses? Those two things in general are the evidence, and it's transparent in an ETF, or it's transparent if you're an institutional investor.
Jerry, the discussion on absolute returns was based around this sort of principle. We all want to be Mulvaney. That's what absolute returns is. It's looking at what is over the long term, what is the maximum CAGR you can get, say, using VAMI. $1,000 start with your capital. What is a maximum you can get over time? And this is where we say Mulvaney's got the solution. But the method that he's deployed to get to that is not a smooth path. It's what we call a path-dependent return. In other words, it's saying that the outliers along the way have been sufficient to change the geometry to really benefit compounding. And that's why Mulvaney is sitting at the top of the ladder over the last 20 years in terms of, compound annual growth rate, total absolute return. When we talk about risk-adjusted measures, normally when people are talking about risk adjusting, they're talking about adjusting returns to Sharpe, to standard deviation. There is an alternative when we can talk about risk-adjusted returns, where we can use path-dependent metrics like drawdowns and different forms of statistics that recognize the influence of the path dependency of the geometry. That is critical. So I don't necessarily think that the term risk-adjusted is wrong, but it depends on the context it's used. If it's used in terms of risk-adjusted to Sharpe, I believe it's wrong, because in this non-linear world, path dependency is so important. So if it is risk-adjusted like Mulvaney to their maximum drawdown or to trend following in general, what we can do is we can say to ourselves, let's compare and contrast the overall performance of the trend following industry using the TTU trend following index, and compare it against a buy and hold investment in the S&P 500. When you do that, you see that the compound annual growth rate of the index of the TTU TF index is higher than the S&P 500, plus the maximum drawdowns over the path that that index has taken is far lower than the 50% drawdowns we've achieved in the S&P 500. So in terms of risk-adjusted returns, we say that the TTU-TF index outclasses the S&P 500 buy and hold in terms of risk-adjusted returns when the risk is a path-dependent risk, not a sharp risk. So that's the key criteria between the buy and hold versus trend following. And then we've got to say, well, let's now compare trend following against, say, Man AHL. Compare Mulvaney against Man AHL. You'll notice that Man AHL has a much smoother equity curve, but they're a very strong, consistent performer. But Mulvaney still beats them in total absolute returns. Their CAGR is higher than Man AHL over the last 20 years. But Man AHL will say, yes, but if we leveraged our solution 2 or 3 times, we'd outclass Mulvaney with lower risk. But the decision was made in the deployment of the strategies, what leverage they'd apply, and Mulvaney has outclassed them, pure and simple. There's a lot of, what if scenarios and speculative scenarios about, but if we did this, it would be better, or if we did that, it would be better. These are all hindsight statements. So that's the thing I've got my issues with.
So if we use...
I agree with all of that. I think that, but especially Mulvaney, I mean, especially him, he cannot talk about returns without mentioning some sort of something he's tethered to as relates to risk, because his returns are so high. So when I'm down 50, don't worry, because, and he needs to, obviously finish that sentence. And so it's kind of like a couple of things going on here. One is, I prefer whatever Mulvaney says is real risk versus Sharp, because Sharp, because they get away with a lot of nonsense with adding to trend following, because they introduce Sharp. You have to introduce Sharp to get any of this to work. And so I like Mulvaney more, like I like myself more, because we have a better handle on what real risk is. Then number 2, I think is what you're saying, is that Mulvaney, this is the fun part, even notwithstanding that, he's just also saying, I'm better, or you should choose me, or there is a benefit the way that he trades as it relates to just having more balls to trade larger. So he and I could trade the exact same way and look at risk the same way and use the same metrics. And he would say, yeah, but I create more return. And Jerry would even agree that I'm not going to blow up and lose all of your money and not stay in the game. And so choose me because my absolute returns are better and bigger because I just have more guts to trade larger. And so I think that's part of it as well, that it's the difference in what is risk, Sharp versus something else. And then it's just a pure pure choice that I'm going to maximize our returns and not be so wimpy. What do you think?
So I mean, okay, so I agree with Richard and with Jerry that Sharp does penalize upside volatility and equalizes it with downside, and it's not good for classical trend followers and for trend followers or for anybody looking for to trade trends, basically, that kind of go outside fat tails, basically, who benefit from fat tails. But we can agree that MAR, or the drawdown ratio, solves that problem, as Richard suggested. So, but if we stick to MAR, like apples to apples comparison, then, which I think is worthwhile, then that's a basis to compare one trend follower with another, no matter how many market strategies or approaches he trades. If somebody has a better MAR over 20 years than another, I think that's a superior trader than the other. Like, what do you guys think?
I knew we were vulnerable to this. I knew that this is why last week I said on the spaces, I'm pretty sure, we've got to just get out ahead of this. And that is, we don't care about that drawdown. The drawdown is irrelevant. Any drawdown, any risk measurement, I wish we didn't have to be so radical and silly, because I think saying this at the same time that it's 1,000% true, it just really allows people to dismiss me as a kook. But it's true. Sorry about that. Sorry, I'm a kook. But the drawdown, in any sort of measurement of risk on an open trade profit, any open trade profit drawdown or volatility that's using any risk measurement is inappropriate for trend following. Done the way that I do it and Richard does it. And once again, because it just is so important that I have made a mistake in downplaying over the years to myself and in my system and into others, people on spaces, who gives a damn, and in podcasts, really. This critical nature of trade level, and trade level being something that's much less than current AUM, something that's closer to closed trade equity, realized profits plus capital contributions. And then I was arguing with someone else this week that that's just kind of maybe half of it. And I'm off on my own here. I'm getting further away from the mainstream here, or the fringe. I'm getting more fringy. And that is not only that, but maybe in equal proportion, not changing it so often. So not only do I use something similar to closed trade equity, I don't update it very often. So maybe once a year or so. So you've got two things going on. Your algorithm is exploiting this redefinition. If you redefine what capital and the trade level is, you can trade larger and you can focus on protecting that capital. But it's this power as well as of consistency of doing the same thing. So I'm trading the same systems with all the markets. I'm trading the same markets all the time. I'm trading the same markets with the same unit size all the time. And my unit sizes are a bit higher than people who use current AUM. So I'm even making up for that. I'm using an artificially low trade level and keeping it consistent as long as I can humanly possible. But then trading larger on the unit size to make up that I'm going to make the same amount of money. And because that's the product of the two is the key. But what the current AUM problem is that it's booking profits that don't exist. You're being very inconsistent potentially in your trading size. Every trade is not traded the same size. And so I think it's a combination of both. If given the choice, I would obviously choose closed trade equity and change it every day. But we don't. That's a false choice because we don't have to choose that. I think it's really just this incredibly powerful combination of trade level choice, doing it correctly, not changing it so often, trading larger on your unit size to make up for that artificially low, well, not artificially, but somewhat artificially low trade level, and then protecting that capital. So you just got to bite the bullet and say, all right, I'm all in on protecting capital. I'm all in on redefining what capital truly is from a trend finding point of view. How could any drawdown of an open trade profit, sad to say, how could it have anything to do? It doesn't with protecting that capital. Zero. If you get close to a drawdown or fatal or a material drawdown in your capital, then you're going to want to cut back your trading size. But no open trade profit has anything to do with that, with risk, when it's looked at that particular way.
So
I love what you say, Jerry, because this is deep experience talking. I'm agreeing with everything you say, but unfortunately, despite what you and I think, we are the allocator's dilemma, because they're after a solution that they can, they recognize that everyone is forced to do this mark-to-market valuation in their monthly performance reports or whatever, We're saying, hey, drawdown on unrealized equity is inconsequential. What you should be doing is looking at any drawdown associated with our realized capital or our closed trade equity. But the industry isn't measuring that. And so we are the allocator's dilemma. It makes it incredibly difficult for us to get our point across because no one can see what we're trying to explain.
Twitter Spaces is this safe place where we can talk about pie in the sky, what's right and what's wrong. And this is sort of what I was trying to get at, with talking about return stacking and all of the different products that are out there. People, really smart people across CTAs and managed futures, they know as much about trend following as I do. And so I am old. I don't have another 40 years left. And I don't need my ETF to be successful. And I can
Yes, you do. You've got another 40 years. Come on.
And I can create my ETF in a selfish way that I want to, and to see if it's going to work. And because I'm not in my 20s and 30s. And so now when I was in my 20s and 30s, I had to do things differently. I had to figure out a good, healthy compromise between theory and what I thought was perfect. And I would balance that off in order to raise assets. And I think I currently do that. I said in that podcast last week, I do the same thing. Maybe I don't consciously understand it, but I brag on myself as, oh, I'm so amazing. I'm going to create this ETF with all these markets and trend following and don't care about open trade drawdown and all this stuff. And so, and watch we'll see what happens. But honestly, I'm sure some of my compromises in order to make it successful, because I do want it to be successful, even though I can say that I kind of don't care, but obviously I do care. And all of our biases like this to be successful and for people to like us, it creeps in to our system and how we do things. So this is what I was trying to say. And I really stumbled badly in trying to say that, but people who don't do it this way, there's nothing wrong with that. They're better businessmen than me. That's one of the things that stands out really well. Why don't I have a bigger business? And so obviously I've made huge mistakes. And I do think, though, that there are some people who will accept us and trust us. And I do think there are people out there who can understand trend following, all these concepts as well as I do. And maybe they're not leading institutions and pension plans, and maybe they're not allocating. But we can have some fun. We can have people invest who love trend following, who understand it, and who want to learn more, like I do. And maybe it's 1 out of 20 or 1 out of 2,000 people. Who knows? But it's worth kind of exploring and experimenting. And I'm really happy that I did that. And this, if we can talk pie in the sky in the spaces, knowing really full well that and in some sort of way, it makes me feel better that, okay, I really do think that we are onto something here, even though we're not going to be able to monetize it. Like worse ideas are, in some respects, are easier to monetize. Sorry, Absolute. Go ahead, please.
Yeah, no problem. So, I mean, we talked about this. I think your argument is well, and at least by myself, I perfectly understand your argument, and it's a beautiful argument. And before you, even though I've been reading about trend following and everything, before you, I had never heard anybody explain it so beautifully and nicely as you do. And I think it's the debate and the problem where in the discussion here is not as much misunderstanding. I think most intelligent people, and especially people who've been in business for 20, 30 or for even 40 years, they understand the argument. It's not like they don't understand. I don't think people, at least successful people in our business, the small percentage who are successful in our business, are stupid people. I think it's a matter of difference in philosophy. And I'm going to try to explain, at least I try to explain it to myself, why the difference exists. Why is there a difference between an intelligent person like Jerry and an intelligent person on the other side of the argument who completely understand the other side's argument? I don't think there's space for misunderstanding. I don't think one side misunderstands the other. I think both sides understand the other side's argument perfectly well. but it's just a philosophical difference. And I think where it comes down to, I think I spoke about this or I wrote about this maybe a few weeks ago, in the terms of the other camps, like my camps, argument or philosophy or belief, and or difficulty to separate closed equity dollar from an open equity dollar, and especially in liquid markets. Like we're talking private equity. If we're talking private equity, I give a guy $1 million. He puts it into some private equity. It says, don't ask me for mark to market in the next 5 or 10 years. Talk to me 10 years later. I'm going to give you $3 million back. Okay? So with private equity, you don't even know what the marks are on a daily, monthly, or even yearly basis because they're all illiquid. They're private businesses. Nobody can value them and whatever. So there's no drawdown. There's no Sharpe. There's nothing to measure. And this is what Cliff Asness was also, criticizing private equity, how private equity has great performance because they don't mark to market. They can mark to market wherever they want, and over 10 years give you smoothness, and for that smoothness, for the returns that they provide in 10 years compared to S&P or something more liquid, they say, look, our returns are much smoother. Well, they're smoother because you're not sampling the market prices every day and every month. That's why they're smoother. But in markets which are extremely liquid, and our argument to investors and to bosses or whoever wants to invest in our strategy is that, look, we're liquid. If you don't like me, tomorrow I can give you your money back. Tomorrow I can get out of all the positions, you can get your money back. It's not like private equity where you have to trust me for 10 years and where can't even tell you what the value of the portfolio is. But 10 years from now, you're going to have $3 million if you give me 1 million now. And just trust me, I've done this before. I know what I'm doing. I have risk protections. I know how to hire managers, how to fire CEOs. I know what I'm doing. Trust me. Basically, so for us which are in what they call this liquid alternative space. So basically, alternatives are non-stocks bonds. So there's illiquid alternatives, which are the private equity guys that don't mark to market every day, and there's liquid alternatives. We are in the liquid alternative space. So because of our ability to mark to market our AUM every minute, every hour, and every day, it's very difficult. And one of the reasons why somebody chooses to go into liquid alternatives is so they can see the marks. So they don't have to trust you. They can see the marks. They're liquid markets. They can see where S&P closed. They can see where London Sugar closed. It's out there on the open. Nobody can manipulate the numbers. So
okay, all right.
Yeah.
I want to get on to another topic, but
Okay.
I don't. Yeah,
I was gonna finish. Sorry, I didn't want to be this long.
I'm with you that everybody understands everybody. I agree with that totally.
Yeah.
But
so basically, they don't agree. They
not
disagree that open trade dollars should be treated differently from closed trade dollars. They disagree.
Well, I know you've said that a lot, and then I was thinking of something else you were saying a lot that I wanted to comment on, but I can't remember it now. But I do think though that you're not, you're just going down this path that is not numbers. It's not. I can't input any of those complaints of yours in my back test, so I'm going to limit what I do to the numbers. And I've manipulated and tricked everyone and tricked the back test by this algorithm, changing it around to look at another number rather than the number everyone else is looking at. And it's actually allowing me to legitimately redefine this risk. I don't give a damn what people want to look at and their mark to market. This is all superfluous junk, marketing crap. And I get it. I mean, you're right. That's all they care about. They understand what I'm saying. I understand what they're saying. I understand they're not going to give me money. They understand that they're not going to give me money. I get it. It's just that I'm more interested in talking about how I'm going to program the computer, program the back test. I find a way to use another number that allows me to legitimately look deeper and more accurately at what real risk is, and allows me to trade larger and maximize my returns, and define this risk in a more conservative way and in a way that is more real and that also allows me to trade larger. So that's what I'm going to do. I've said before, if we just shut up about it and we acted like Renaissance and we can't talk about our algorithms and how they work. We just are churning out these big returns and we're staying in business. And Richard came up with this idea a long time ago, saying, look, that's the ultimate. The ultimate measurement of risk are these long-term track records produced by these CTAs who have been around for all these different years and they're still around. And so once you start getting away from the fact that, are you still around? Are you still in the game? And you've traded this way, and this back test shows for many, many years, not getting close to drawdowns that would force you to quit and allow you to stay in. The further you get away from this sort of a measurement of risk, you start tickling yourself with all this sharp crap and volatility stuff and adding in DPS and all this silliness and convincing yourself that risk equals volatility. Okay, so I don't want to talk about that anymore. I want to go on. Oh, there was another podcast that was really a good one. And I tweeted about it. And it came from Meb Faber, and he was interviewing these guys who I really like, Batnick, and I think his name's Carlson. And so these are guys kind of in the traditional RIA world, I think, and they're not like hardcore trend followers, but they know a lot about trend following, and they use trend following, I believe. And so they had some amazingly fun quotes, and sort of coming from RIA type guys, Red Holtz in that group, and seeing the value of what our main profession and the thing we love so much. And here's how they start. This was just a brilliant tweet. A brilliant quote. Trend following is the one true strategy that you can actually believe all the back test, because price is the one key. Price is always tied to human emotions, and no matter the environment, it's the one thing that is constant. The price tells you everything. Everything else is baked into price, regardless of the environment. I thought that was really good. Didn't agree with the market cap thing. It's the ultimate trend following algorithm. We could talk about that. That's something that Meb said. Here's another insight. We looked very deeply at selling or trimming our positions in an extended market, like 1, 2, 3 standard deviations above a moving average. We couldn't find anything, and we tried. Nothing in the data added value to the portfolio. So it's pretty interesting. Obviously they didn't use Sharp. So they were much more bottom line-ish about this. So, just introduce Sharp and you can find all sorts of reasons to trim. Oh, yeah. But their way of looking at it was, we want to make more money. Yeah, we're like, is there an indicator out there that says at some point in time these trends get too far, too much, too crazy, and let's just trim it a bit? 1, 2, 3, whatever standard deviations. And they're like, no, nothing. Nothing would help us in this particular trade. Of course not. And this is what we always talk about. Nothing is going to tell you to get out of the trade better than your exit. By definition, I'm going to comment on something that just popped into my head from Absolute. That is, by definition, letting profits run and treating and taking small losses. From the beginning of trend following time, we're treating the two equity curves differently. We're treating the trades differently. If it's a loss, we treat it one way. If it's a profit, we treat it a whole different way. The good thing about it is we treat both optimally. It's a game. It's a strategy we've come up with. It's not rooted in fundamentals or research or mark to market. It's just a trick we're playing on the markets and people in order to grab money out of the markets and stay and not lose too much of our capital. Oh yeah. Oh yeah. Oh yeah. Another thing that Meb did on this podcast was he thinks I'm 10 years older than I really am. So I thought that was irritating. Oh yeah, and this is one, I guess, my favorite.
You've got to laugh.
Yeah, he said, I've been in business for 50 years. What? What are you doing? That's fine. I hope it ends up being true. It's easier to convince a naive investor to give you their money if you've got trend following plus all these bells and whistles, but we threw everything out. And then someone said, if this works, why isn't everyone doing it? My answer was that it's not bullshitty enough. It's hard to sell because it's too simple and it's elegant. Bullshitty. I love that. Yeah, it's not bullshitty enough. That's right. We have a major issue with bullshittiness. If you want to raise more money, you've got to throw in more bullshitty. And I would put sharp number one, volatility number one, caring about open trade profits number one on that list. So I thought this was a great, highly recommend going back and listening to Meb and his, he did stumble on into, oh yeah, oh, oh yeah, what was this other one? Okay, I can't find it, but then they go on to say, the thing I love about trend following is that it removes emotion because my instincts for getting in and out are almost always wrong. No one felt like it was a good time to get back in when the rules were saying to get back in, and no one could have predicted the stock market would take off. You have to follow these rules come hell or high water. And they go on to kind of mention something that I learned as well, which is one of the reasons that they didn't want to get back in is because they were losing money with the trend following, and the market was so choppy, and the previous losses were impacting their emotions. And I found that to be so true. I think if you can, like I said before, if you can kind of, well, the turtles used to have this rule that you buy the breakout, quicker, a quicker breakout if the last trade was a losing trade. So I think that whole mentality is so true that if the last few months or the last few trades have been negative, that's going to make the next trade better, and then you can probably get in a little bit quicker. Now, you want to systematize all this and do it the right way. There was a lot of trend discretion with the turtles, but I do think that that's a great thing, and that is exactly what bums people out. Is like I can't take this next trade. I've lost in this market 5 times in a row. I don't want to do it. Or trend following in general, I've just been losing and losing, and so this just definitely impact people. Anyways, anybody want to comment on any of what I thought were pretty fun, good quotes?
I really love that podcast, Jerry. I think Meb is a closet trend follower. I've often heard him talk glowingly about our craft, but it was interesting hearing those other two guys and some of the stuff. Yeah, I was certainly shaking my head, but a lot of the other stuff that you mentioned, yeah, I questioned it, the cap weighting stuff. I must admit that this idea of in a congestion zone, when you're taking breakouts and a lot of them are failing, naturally, if there is going to be a breakout, that inevitably means that as you progress through a series of losses, there is a greater probability in a serially correlated environment. This is not an independent bet environment. This is a serially correlated bet environment that the next trade is going to be the one that gives you the breakout. So, this comes down to a real grief I've got at the moment in when people talk about randomness and when people talk about chaos and these concepts. I think these are concepts that don't fly in our world. I think that there are different ways to express these things. I prefer the term noise to randomness, but when you go into a betting environment like at a casino, you realise that when you're at the roulette table and the wheel's turning or the dice is being rolled or the cards are being turned, that the bets are independent in nature. Say tossing a coin, an independent bet. However, I think in our environment we've got a bias coin, and I think that bias is reflected in a serial correlation, which therefore alters the probabilities over the course of time. So I think your idea of, if you are progressively in a situation where you are incurring losses with your trend following model, you're in a congestion zone, I think that demands that you do take every rule and you don't get to the point of giving up, because that very next trade is probably, probability speaking, more likely to be the breakout than the past sequential 4 losses in a row.
Yeah, I think that it kind of works. Oh, this was an older quote I saw. I got this off of a podcast, probably with Eric. Eric just has this way of making things very clear. I don't always agree with how he trades, but he has this ability. I've had these private emails discussions with him over the years, and we were talking about certain things, and he will like reply, and I'll say, "Oh, can I tweet that? Can I tweet that?" He's like, "Sure, sure." So this was one of the things that he talked about a few weeks ago on a podcast. Crap, I can't think which one it was, but he goes, the returns of different asset classes stack up on each other, but the volatility, risk, and drawdown dilute each other if you have non-correlated assets, or even if you have assets that are, in my opinion, somewhat correlated, which I thought was a good way of expressing it. Returns stack, drawdowns dilute. And here's the big one. I'm trying to help people want what they need. I think that's what people are trying to do. They understand trend following. They love trend following. They understand it as well as I do. They use it, and they're trying to package it in ways by with stacking with traditional assets, long bonds, long stocks all the time, plus some managed futures on the side, or they're trying to make it a little bit more palatable with DPS or whatever. And so I just think it's fun to talk about the differences, and there are differences, and no one's talking about them but us, and the pros and cons. And so we don't hear a lot of the cons of these situations of doing things this way. And I guess probably to promote my own fund, I'm just like really interested in talking about the way I think things optimally done, but optimally is a selfish concept when it comes to asking people to not really to help them want what they need. It's more of like taunting them. I'm like, fuck up, man. Come on, be tough. You should want this style of trend following that really puts you makes you uh, love those drawdowns, love those losses, and I think it's two different ways of at least two different ways of doing things, and I respect and admire everybody who's trying to make a living and have a product that's successful and get people to at least try to do a bit more trend following. And I have the ability and the desire to give them a really strong dose of broccoli. And I don't think maybe broccoli is not even, it needs to be something way worse than broccoli to make my point.
Scale.
Just one final question, Jerry. Now you mentioned the assets under management and your experiences with managing money and whatnot, but overall, in one of the podcasts, I think with the TTU, you were also talking about the overall performance of the trend following funds in general in the industry. That your point was the total assets under management is less than 1 in 1,000 of the managed futures. So managed futures are just possibly managing like 400 billion, and if I'm not mistaken, you mentioned like 300 million of the total assets in all the firms in classic trend followers. So so this indicates not a person or a trader or a fund specific case, but I mean, isn't it? It seems maybe there is a wider misunderstanding of the product in the marketplace, and it's not very trader specific as well. Thank you.
Yeah, I'm not really up on total assets that CTAs manage, but I do think that it's pretty obvious that in managed futures and trend following today, it's just a given that DPS is minimally DPS. It goes much deeper, probably even gets it's better words to use, the depth at which trend following is sort of overwhelmed by this money management overlay and DPS and smoothing. It's just a given. It is absolutely just a given. And if you're the assets of people who don't do that are pretty small and non-existent. I don't really remember at what point I was trying to make or this discussion, but it is, Niels talks a lot about, I just don't see the difference. I haven't noticed any kind of meaningful difference, but really there's nothing to compare to. The, who's out there besides Chesapeake's record, and we haven't always let profits run the way we do now. And with loose pants as much as we do now. So I'm not probably even a good comparison, but it's all there in the back test. And I think another thing too, I've said before, if you get too far away from justifying more of a classic approach, from just saying it's fewer parameters and fewer variables, then you're going to get sucked into an argument that you're eventually going to say, oh, I got to go back to that. So the reason I don't do it, I can definitely agree that maybe there's not much of a difference. That I don't want to make my argument that there's going to see this big, huge difference. I'm not sure that you will, or when you will. I think you probably will, but I feel more comfortable protecting capital in the way that I've described it and letting profits run and having fewer variables and fewer parameters and fewer rules. That's just me. So I think that's the best argument for doing it, which may never manifest itself to a degree that real-time performance that sways anyone other than yourself.
Jerry, I just wanted to ask you, you tweeted a video of Bill Dunn being interviewed, and I had a good listen to that interview, and I thought what came out of that interview was that he was suggesting that maximum diversification was the ideal scenario. So is that your take as well? And if that's the case, has the opinion changed in Dunn post Bill Dunn?
Wow. Yeah, I agree. I mean, that's kind of where I was headed. Bill Dunn was in favor of more markets, maybe more long term. It was some good quotes. It's an old podcast. The holding period is a result to the model. The model didn't say I want long holding periods. It wants to capture these not particularly popular but very large sustained moves, which I maintain do not have to do with randomness. Yeah, I think that was just old school Bill. I don't know if the all the changes to managed futures that and DPS he's disappointed in, or maybe he sees it as a improvement, or he just says, I'm retired, I don't give a damn. So I just think it's interesting to go back and listen to, it was pretty interesting. The first quote was interesting as well, where he was like, yeah, we were getting kind of worried that we're going to raise too much money. Commodities would be less of a influence on our performance. So we decided to split it up into two different programs, one with no commodities and the one with commodities. But then we sort of said, yeah, that's a mistake. Let's just go ahead and put commodities in, even if we can't have this optimal allocation to commodities due to position limits or liquidity, we'll still put commodities in there. So I was hoping, as the further I went, he'd say, we could really get him on record for loving 300 markets or.
I was waiting for that one.
Yeah, and I was hoping we could get him on record as saying, let those profits fluctuate. Don't have any sort of DPS-like ideas. But nope, it wasn't really that. I didn't see anything that we could sort of say, and it was just, he's a great, smart guy. And
do we agree? He looks like Bruce Willis.
Yeah, not too far off. Yeah, so it was really interesting, and he's great. People love Dunn and love Bill Dunn. When I listen to podcasts, his name really comes up to a lot of people, and most of the old time trend following people. I know obviously I love Rich, And I can always find a fault with most of the other ones that I don't really bond with the old guys who started. And, but everyone else loves them more than I do. But Dunn, I put him right up there. He is a great guy, and he's got a great mentality. And it's really impressive that he came up with this stuff kind of on his own without knowing that Richard Dennis was out there or whoever was out there, Donchin or Sakota. But I don't really have any complaints with him as far as the things he says and how he traded. And great guy, great trend follower. I got to share a taxi with him one time, I think, and should have kept going with him and hung out with him as long as I could have. But great man, great podcast. I need to go find some more. Melicinos put that in my inbox, and I enjoyed listening to that.
I have been enjoying your podcast with Mike. They've been great.
I did a 2-hour, 2.5-hour podcast yesterday, which was outrageous. And I'd never been on a podcast that long. I had to use the bathroom so bad. And then we finally ended, and it was great. And it's coming out soon. I'll post it, but it was
You're probably both busting to go to the bathroom,
yeah.
but you're such a competitive pair that you decided to hold out on each other.
Exactly. And my wife is like, "Well, how did it go?" I'm like, "She let me talk for 2.5 hours. Like, it didn't really interrupt me. So how do you think it went?" I think it went wonderful. So more of the same, though. Nothing you hadn't heard before. Okay. Anybody want to say some parting words or question or comment? I'll give it another 5 minutes or so. If you want to not, we can say goodbye for the week and get to the important trading stuff. Peter?
Jerry, I wanted to regarding the broccoli comment you said. There's a saying by a U.S. boxer that was something like, "Everybody wants to go to heaven, but nobody wants to die." And I think that's something that applies to any trading strategy. That it's good in the end. You got to suffer, and you got to accept and like that suffering.
Well, I think that when you do the research, you like I said, I think being systematic and research driven and sample size obsessed, you will start coming to these conclusions that are a result of the research, which is trend following, number one. And weird, isn't it kind of interesting how 40% win rate, which is not really nice and fun, and a lot of small losers, letting profits turn into losses, letting big profits turn into small profits. And you can go broke taking profits. You can come up with a lot of things that it just seems to be, if you're pursuing, you can hardly outdo the computer with being too long term. You can say, I'm the longest term and no one's longer term than me. Then you just put in another parameter and the computer says, well, that's longer term and that's even better. So that's just the worst thing ever, having to be so long term and watch these profits kind of go away. One thing that's been happening recently, I mentioned before, is like I've long a couple of wheats, short some wheats, and long beans and oil and meal. And I haven't really done a trade in those markets in a while. And so I think that those markets are just the worst recently of just getting chopped up and nicked up. You're long corn, now you're short corn. And the same with wheat and the beans and the oil and the meal, let's say. And so you have a tendency to not pay attention to those things. And they're like small nicks, but they add up over time. And then your eyeball is focused on, oh my God, look how much I gave back in OJ. Where when you sort of add the two up, you gave back, you traded optimally in OJ based upon 50 years worth of data. But you did give back a lot. And then you subtract out all of the nicks that you didn't get hit by because you're so long term and your stop loss is pretty long term as well. then you're like, oh, okay, I see why my performance is very similar. How can you have similar performance when you're always giving back way more profit than everyone else? And that's because there's these other like benefits that they're small, but they're numerous. And that's what Rich used to say about limit orders. You know, you put a limit order in a tad below the market when you're buying, then you're going to get that trade 90% of the time. You're going to have to chase it 10% of the time, and you're going to remember, oh my God, remember that time I had to chase that market and I ended up getting it 1 ATR higher? I could have just done a market order. And then you do these market orders, and then you always get nicked a little bit every time. But your brain is like, that's not that big of a deal because it's always a little small loss. But the big thing you always remember is chasing that market or chasing those markets and having to pay way more than you would have paid if you'd have just done the market order. And so you want to avoid that as a human. That's the thing you want to avoid. And yet when you add them up, the limit order is far superior because, yeah, it's how our brain works. Regardless of what the numbers are, we prefer less pain. Sorry, I went off on that.
Hey guys, this is Pete Carmesino. Can you hear me okay?
Yes.
Hey, great. Oh, great discussion. You guys had so many topics. It's hard to jump in because I know the flow of the call continues. But back to what Richard was talking about a few topics ago about trend following being sort of the allocator's dilemma, and I wanted to kind of expand on that a little bit. But you kind of talked about what people are looking at and measuring. You talked about what Ritholtz looks at and the way they're kind of running their RIA. So I was in RIA for many years and came across the same issues. And I just think that it's just a dogmatic thinking, based off of Markowitz and modern portfolio theory and efficient frontier. And everybody gets into that box of risk tolerance for the person that they're running money for rather than risk tolerance for the money that they're allocating into a certain strategy, right? So there's different ways to look at it, and I think that's one of the shortcomings is that the business in general of investment advisory has sort of just evolved, right? It hasn't really been a revolutionary change, and I think trend following absolutely fits in every category of investment management, whether it's long-term, short-term, whatever the case may be. But it's a way that I think people have defined something based off of efficient frontier, looking forward, worried about volatility, and that risk tolerance of the person rather than the money that they're allocating, I think is really the key differentiator. What I mean by that is risk has two components, right? Willingness and ability. And that is emotional. And I think that risk or trend following sort of solves for a lot of that, because if you look at what Markowitz was saying, he was saying something about the strategy, choose a strategy that maximizes the best utility or expected utility for a many period game. The issue is that he's been off, quoted individually and saying that he's never, quote unquote, been a buy and hold person himself before he passed, obviously. And it's just ironic that the whole industry, after he won his Nobel Prize in 1990, shifted completely toward a maximized, diversified portfolio to sort of control volatility and things of that nature. But I just think what Richard said was spot on. Allocators are just trying to fit everything into a box, and if it doesn't fit, it becomes a dilemma. They're creating their own dilemma when there's better strategies out there. So I just wanted to touch on that.
Yeah, and I think that we would get in there sometimes and go to an allocator, and they were interested in CTAs, and they're all supposedly interested in new strategies, new ideas. And so we would say, yeah, okay, we've sort of sat still, not done anything, and now we're really different. We've stayed with letting profits run and not managing vol. And so put us in the portfolio of your CTAs and just hide us in there. I mean, if nothing, we're doing things differently. Maybe we trade a few stocks as well. If you can handle that, great. But certainly put us in but because it doesn't have anything to do with that. It has to do with you're violating what they think. It's too different, and we've moved on. And you're really pressuring me, and you're almost saying, if you allocate, you're so out there with it that I have to sort of agree with you that what you're doing is correct, and then that's just going to upset everything that I have come to believe. So it really is a situation. I think that it's different for retail. I think there's a lot of retail people who love trend following like I do and did, and more interested in. I don't think I've often said, I would go to these meetings with institutions, and I would be half a dozen people in the room at the conference room, and I felt like at some point that I was way more likely to get an investment from any of those 6 people individually, personally, versus getting anything from the organization that they represented. It's just, and I think this is what these guys have picked up on, and that is if you tone it down a bit, and we came from trend following centric and not knowing anything about trading and managing money, and then believing everything we were told from people who, bottom line was staying in business and making as much money as possible and making no compromises. And trend following was wonderful. One entry, one exit, and a stop loss. And then a lot of the European invasion was physics and PhDs and maths. And then not turning your back on that, and let's incorporate some of this trend following into what we already know. So it was way more suited for them to come in and have these big businesses. But then some of the U.S. guys, some of the turtles, they did in fact start doing that as well. And trend following was core maybe, or a major part of it, but it definitely has to evolve over time and be more of a part of what's going to happen. And that's what everyone prefers, even if they would prefer it if regardless of what the results were. Okay. It's okay. No 3 hours this time. So that's good. Hope you guys had fun, and we'll get back at it next Friday. I'll be traveling in, it's going to be, I'm traveling a lot. So it's going to be next, I think, Thursday, not Friday, next Thursday. Yep, next Thursday I'll be in New York City, and we will broadcast spaces from the West Village of New York City. Yes, because I'm on a flight to California Friday. Okay, it's been fun. Thank you, Richard. Thank you for the recordings. Have mercy on me in compliance. Everybody have a good weekend. Take care.